Welcome to Andy Oakley Investigates once again. Today, we're diving into one of the most important economic ideas for New Zealand's future. New Zealand First Leader Winston Peters' proposal to buy back the Bank of New Zealand from its Australian owners and merge it with Kiwibank. Why is this a good idea? Because from a modern monetary theory, or MMT perspective, a government-owned bank changes everything. It could let us offer low or even no interest mortgages to Kiwis, keep banking profits here instead of flowing overseas, and finally stop the corporate vacuum that's sucking money out of our economy. But to understand why buying it back makes sense, we first have to go back to why we sold it in the first place. So stick with me. I'll explain everything in plain English, even if you've never heard of MMT. No jargon, no lectures, just the truth about how money actually works in a modern economy like ours. So if you're tired of high mortgage rates, struggling productivity, and feeling like New Zealand is slipping, this episode could change everything how you see an entire economy. Let's investigate. Why we sold the BNZ, the neoliberal sell-off. Let's rewind to the early 1990s. The Bank of New Zealand, which had been government-owned for decades, was sold off. This wasn't some minor deal. It was part of a bigger wave of selling off public assets. And the key figure here is Ruth Richardson, who was finance minister in the national government. Her approach, often called Ruthanasia, was pure neoliberal thinking. Cutting spending, slash welfare, and above all, privatise anything the government owned. This thinking got baked into laws like the Public Finance Act and the Fiscal Responsibility Act. These acts push governments to chase budget surpluses and treat the government's books like it's a household budget and sell assets to balance the books or raise quick cash. And the BNZ itself had needed a bailout earlier because of bad loans in the late 80s. Instead of fixing it as a public bank serving New Zealanders, they sold it to National Australia Bank, that's the NAB, around 1992 for roughly 1.1 to 1.5 billion at the time, about 3.5 billion in today's money. Winston Peters, who was in that government, now calls that sale a disgrace. What did selling off government assets actually achieve? Well, on paper, it added some numbers to the budget. It gave a short-term cash inflows. But here's what really happened. Those assets, banks, railways, telecom, energy companies, were handed over to private corporations, many foreign-owned. Those corporations then vacuumed up profits and sent huge chunks overseas. Instead of that money circulating here, paying wages, building homes, or investing locally, it flowed out. Businesses and ordinary Kiwis ended up with less to spend. Demand in the economy weakened, productivity growth, which looked promising right after the reforms, slowed dramatically in the following decades. New Zealand's productivity performance was weak compared to what was promised, with very low growth in recent years. The neoliberal idea was that private owners would be more efficient, but efficiency for who? For shareholders chasing maximum profits, often overseas, not for New Zealanders. The real cost, corporations vacuuming up our money. If I just look over to the graph there that you can see on your screen, you can see that New Zealand, in terms of real GDP per capita, was only really behind America. It was ahead of the rest of the world, even from 1870. So just after the treaty was signed, New Zealand was per capita had real GDP and was just as good as America for a long time. And then you can see as I'll grab the laser if I can. Laser, yep. So there's the black line there is New Zealand. And we were above most Australia, Canada, Denmark, South Korea, Sweden, and we were up with the United States, but United States obviously a superpower and surged ahead. But from the mid-70s New Zealand's productivity fell behind nearly everybody. And there's the dip in the 1990s when Ruth Richardson put in the act. And you can see down here that it's not as if New Zealanders don't work longer than everyone else, they do. So I'll just get rid of that highlighter. So by selling public assets, we didn't just lose ownership, we lost control over where the money goes. And today, 4 big Australian banks control about 85% of New Zealand's banking system. They make billions in profits every year from Kiwi mortgages, businesses and deposits. And a big portion of those profits head straight across the Tasman. This is exactly what the critics of the old system feared, but in reverse. The government no longer creates and directs credit for public benefit. Instead, private banks create money through loans, but they do it to maximise returns for their owners. The result? Higher interest rates for Kiwis than necessary, less money circulating in our towns and cities, and weaker demand, which drags on productivity and wages. It's a slow bleed. Corporations mop up the financial surplus that should be building our country. This isn't some conspiracy. It's the logical outcome of treating money and assets as things governments can't afford to own. But that thinking is based on a fundamental misunderstanding of how a modern fiat currency actually works. So why do our leaders think this way? Bad economic education. Here's the root problem. Most politicians and economists in New Zealand were taught an outdated view of money. They were trained in universities that still teach economics as if we were on the gold standard, or as if the government is like a household that has to find money before it spends. They parrot the line, the government doesn't have money of its own. Seymour and Luxon are saying this all the time. So's Nicola Willis. It has to tax or borrow first. But that's simply not true for a country like New Zealand that issues its own sovereign currency, the New Zealand dollar. Economists like Stephanie Kelton in her book The Deficit Myth, which Winston Peters has read, by the way, explains this clearly. Governments that control their own currency don't need tax revenue or bond sales to spend. They spend by creating money, literally keystrokes at the central bank. Taxes and borrowing then manage the economy. They remove excess money to control inflation and give the currency value. I just ask you you could put a pause on this slide and have a read of the graphic there. It's an illustration of how the current economy actually works. Steve Keen, another brilliant economist, backs this up with his work on debt and money. He shows that government deficits create net financial assets for the private sector. When the government spends more than it taxes, that extra money ends up as the savings, profits, or investments in businesses and households. It's not printing money recklessly, it's how you keep the private economy healthy. Our politicians don't understand this. They graduated from the same system that taught the neoliberal playbook. Even if they read Kelton or Keane, trying to explain it in Parliament would get them laughed at, which is probably why Winston doesn't mention it. The dominant view is still, we can't afford it or it will spook the markets. This misunderstanding is dangerous. It's an existential threat. If we keep operating under these old rules, selling assets, chasing surpluses at all costs, letting foreign banks extract profits, we risk becoming a hollowed out economy, more like a third world country in terms of opportunity and independence. Explaining MMT simply, how a sovereign government budget really works. Let's make MMT crystal clear. Because once you get it, everything changes. Imagine the government is the scorekeeper in a giant game of Monopoly, but it's the only one who can create the game's money. The government doesn't need to collect taxes first to spend. It creates the dollars when it spends them into the economy. Taxes are like removing some of the money from the board so the game doesn't overheat with inflation. Borrowing, which is really issuing bonds, is a tool to manage interest rates and give the private sector a safe place to park savings. Now, if the government owned the BNZ, there's no need to issue bonds for people, a safe place to people to park their money, because it'll be a government-owned bank, so they could stop issuing bonds altogether. Now, Stephanie Kelton puts it perfectly. The limit on government spending isn't some magic number in the budget. The real limits are inflation and our actual resources: workers, factories, land, material. As long as there's slack in the economy, unemployed people or unused capacity, the government can spend more without causing problems. Steve Keen adds that private debt is the bigger danger. When households and businesses are overloaded with debt, the economy slows. Government deficits counteract that by injecting money and supporting demand. In short, a sovereign government like New Zealand doesn't go broke the way a household or business does. It can't run out of its own currency. The budget isn't about finding money. It's about choosing priorities for what we produce as a country. This is why a government-owned bank is so powerful. It doesn't have to chase profits for shareholders. It can focus on the public good. The BNZ buyback, low or no interest mortgages, and beating the Australian banks. Now, apply this to Winston Peters' idea. Buy back the BNZ, merge it with Kiwibank, and create a true national bank of New Zealand. Under MMT, the purchase itself isn't a solvency issue. The government can fund it because it issues the currency. The real question is how we use that bank afterwards. As a publicly owned bank, it doesn't have to run a profit like the Aussie banks do. It can offer low interest or even targeted no interest mortgages to New Zealand citizens, especially first home buyers or for productive investment. This would immediately make housing more affordable. It would drive down rates across the whole market as the big four Aussie banks face real competition. In fact, I wouldn't be surprised if they go all together, which would be a good thing for New Zealand. Profits would stay in New Zealand, recirculating here instead of funding Australian shareholders. We regain sovereignty over our credit system. More money in Kiwis' pockets means more spending, more business investment, higher productivity. The old neoliberal crowd will scream reckless or it'll cause inflation. But MMT tells us we manage that by making sure the spending matches real capacity, not by artificially starving the economy of money. I've been Andy Oakley, and thanks for listening to Andy Oakley Investigates today.